5 common 401k mistakes and how to avoid them. If you've been saving diligently over the years, chances are your 401k is one of your largest retirement assets. But here's the part that surprises a lot of people. It's not just about how much you saved, it's about how you use it. Because even with a 7-figure balance, I've seen retirees lose tens of thousands of dollars in avoidable taxes, missed planning opportunities, and poorly timed withdrawals, just because they didn't fully understand how their 401k fits into their bigger picture. For example, should you be using the Roth 401k option instead of pre-tax? Are you prepared for required minimum distributions at 73 or 75? And what happens to your 401k when you pass? Does it go to your heirs efficiently or become a tax burden? These aren't trick questions, they're common situations that without proper planning can quietly work against the retirement you've worked so hard to build. Hi, I'm Josh Bliss, founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. We help successful pre-retirees and retirees turn their portfolios into tax-efficient retirement income and protect their wealth across every stage of retirement. In this video, I'll walk you through 5 of the most common 401k mistakes I see when people transition from savings to spending, and more importantly, how to avoid them. If you find this helpful, be sure to like the video, drop a comment, and subscribe for more clear strategic retirement guidance. Let's get started. Mistake number 1, letting old 401ks sit unmanaged. This one I see all the time. You change jobs, move up in your career, and each time you leave a trail of 401ks behind. By the time you're nearing retirement, you might have 3 or 4 old 401ks scattered across different platforms with no coordinated strategy tying them together. Here's why that's a problem. No coordination. Each account is likely invested differently based on default options from years ago. No rebalancing. These accounts don't manage themselves. Over time, they drift and create unintentional risk. No tax planning. It's hard to plan Roth conversions or income strategies when your assets are fragmented. No simplicity. Juggling multiple logins and statements only adds stress when it's time to withdraw income. What to do instead? In most cases, it makes sense to consolidate, either into a single IRA that gives you full control, or if your current 401k is well managed and low cost, roll older balances into your current plan. The key is to do this as a direct transfer, so you avoid triggering taxes or penalties. Here's a real life example. I worked with a client who had over 1.8 million spread across 4 401ks. One hadn't been reviewed in over 10 years, and it was still 80% in equities just 6 months from retirement. We consolidated the accounts, restructured the investments, and aligned everything with the withdrawal strategy. The result? Less risk, more clarity, and a plan they could actually follow. Mistake number 2. Missing the Roth 401k opportunity. Many high earners default to traditional 401k contributions because it lowers taxable income today. But what happens later when your retirement savings are all tax deferred? You may be setting yourself up for large required minimum distributions, also known as RMDs, that push you into a higher tax bracket just when you want to enjoy your retirement. Here's why Roth 401ks deserve a closer look. There are no income limits to contribute. You get tax-free growth, and withdrawals in retirement are tax-free. It's especially worth considering if you already have a large traditional 401k balance, you expect high taxable income later from Social Security, pensions, or RMDs, you want tax diversification across retirement. And don't forget, Roth 401ks do have RMDs, but you can avoid them by rolling the funds into a Roth IRA after retirement. Blended strategy example. I helped a couple in their early 60s who had already saved over $2 million in tax-deferred accounts. We had one spouse switch fully to Roth 401k and the other do a 50-50 split. We also laid out a Roth conversion plan once they retired. This gave them much more control over future taxes and flexibility in how they withdrew money later. Key takeaway: don't default to traditional just because that's what you've always done. The Roth 401k may give you better control and tax efficiency, especially in retirement. Mistake number 3, taking withdrawals without a coordinated plan. Here's another one I see too often. Someone retires and just starts pulling money from their 401k because they need income. No real plan, no tax coordination, no thought about sequence. And that can quietly create problems, like jumping into a higher tax bracket, paying more for Medicare due to IRMAA surcharges, triggering capital gains taxes elsewhere because total income is higher. A smart withdrawal plan should include when to take Social Security and when to delay, which accounts to draw from first, taxable, tax deferred, or Roth, how to smooth income over time to reduce RMDs, and strategies for managing your tax bracket each year. Real example, a client was was going to retire at 64 and take Social Security right away. We held off until age 67. During those first few years, we drew modestly from their 401k, keeping them in a low tax bracket. And we did small Roth conversions to start reducing their tax-deferred balance. The result? Thousands saved in taxes, higher guaranteed Social Security, and lower RMDs later. And they had a clear, simple plan for the next 20 years. Key takeaway? Your 401k isn't just a savings account, it's part of a broader tax and income strategy. Don't let random withdrawals derail your retirement. Mistake number 4, forgetting about beneficiaries and estate planning. Here's what most people overlook. Your 401k doesn't go through your will. It passes directly to the person named on your beneficiary form. And if that form is outdated, your money might go to someone you didn't intend. Examples I've seen: a remarried client still had their ex-spouse listed. Another had no contingent beneficiary and it defaulted to their estate. On top of that, since the Secure Act, non-spouse heirs must withdraw the entire 401k within 10 years. That means adult children could be taxed heavily during their highest earning years. What to do? Number 1, review your beneficiary designations every 2 to 3 years or after any major life change. 2, make sure your estate plan and your retirement accounts are aligned. 3, if legacy planning is important, consider partial Roth conversions so heirs receive tax-free assets instead. Real story. A widowed client of mine had 2 adult children as beneficiaries, but we saw that each child would have to withdraw over $100,000 per year from the inherited 401k, all taxable. We implemented a 5-year Roth conversion strategy. That small change created a long-term tax-free inheritance for the next generation. Key takeaway: your 401k isn't just about your retirement, it's part of your legacy. Make sure it's structured accordingly. Mistake number 5, ignoring required minimum distributions, also known as RMDs. RMDs often feel far off, but they can cause big problems if you don't plan ahead. Starting at age 73 or 75, depending on your birth year, you're required to withdraw a portion of your tax-deferred accounts every year, even if you don't need the income. And yes, 100% of it is taxable. For many retirees, this creates higher income than expected. Medicare premium increases, less room for tax planning, and forced distributions that can push you into a higher tax bracket. Planning early makes all the difference. Here are a few strategies. Start Roth conversions in your 60s before RMDs start. Use bracket management to fill low tax brackets intentionally. Use qualified charitable distributions, also known as QCDs, to send RMDs directly to charity tax-free. Align your asset location so the right investments live in the right accounts. Real case: a client of mine came in at 71 with over $2 million in retirement accounts. He had deferred all withdrawals and planned to delay Social Security until age of 70. Sounds smart until we saw the RMD math. Once RMDs kicked in, he'd have to withdraw over $80,000 annually. Add Social Security, and he'd be bumped into a much higher tax bracket with fewer planning options. We adjusted, started IRA withdrawals right away at low rates, did Roth conversions over 3 years, smoothed out income to avoid a big spike later. Your 401k is more than a savings tool, it's a retirement income engine, a tax lever, and a potential legacy asset. If you're 5 to 10 years from retirement or already retired, it's time to start thinking strategically. If you want to make sure your 401k is working with your plan, not against it, let's talk. Click the link in the description below to book a free consultation. I'll walk you through your current 401k strategy, help you spot any red flags, and show you how to align it with your income and tax goals. Thanks for watching, and I'll see you in the next video.